You've probably heard it before, right? Maybe at a family barbecue or from a well-meaning neighbor. Just sell the house to your kids for $1. You'll avoid probate. It sounds so simple, so clever. But what if that brilliant little shortcut is actually a minefield of tax complications? Well, that's what we're here to figure out.
All right, so let's say you've gone and done it. The paperwork is filed, the keys are handed over, and you sold your house for a single dollar. So the big question is, did you just send a formal invitation to the IRS for a tax audit? The answer, as you might guess, is a little more complicated than a simple yes or no.
Okay, here's our game plan. First, we're going to look at how the IRS sees this deal. Is it a sale or a gift? Then we'll dig into a scary audit risk that literally never expires. After that, we'll talk about a huge tax bomb you might be setting for your own kids. Then we'll cover some other nasty traps, and finally, we'll talk about how to fix this mess or, do it the right way from the start.
All right, first up, what are we actually looking at here? You call it a sale, your son calls it a sale. But you know who doesn't call it a sale? The IRS. They have a core principle, substance over form. They don't care what you call it. They care about what it is. Here's how the IRS sees it. They call this a part sale, part gift. That $1 you got? Yeah, they see it, but it's basically irrelevant. What they really see is the economic reality. You just transferred a massive amount of wealth for essentially nothing. That's not a sale in their book. It's a gift.
And that huge difference between what the house is worth and that $1 price tag, it has a name. It's called a gift of equity, and that is the taxable event. So if your home is worth, say, $500,000, you didn't just sell a house, you just made a gift of $499,999. And trust me, the IRS is very interested in gifts of that size.
So, you might be wondering, okay, if it's such a big deal, why didn't alarms go off immediately? Well, it comes down to this number, $600. See, normally when you sell real estate, the closing agent files a Form 1099-S. But there's a little exception for transactions under $600. Your $1 sale slips right through that automatic reporting crack.
But here's the trap everyone falls into. Don't get too comfortable just because a 1099-S wasn't filed. This transaction is anything but invisible. The deed, the transfer of title, it's all right there in the public land records at the county courthouse. It creates a permanent paper trail that any auditor can find with about 5 minutes of work, even years later.
And this brings us to the most pressing danger of all. Because you thought it was a sneaky, under-the-radar sale, you almost certainly didn't file the tax form you were supposed to. And that one failure to file has a truly staggering consequence.
Now, this is absolutely critical to understand. There's a huge difference between reporting a gift and actually paying tax on it. For 2025, any gift you give to one person that's over $19,000 has to be reported on a Form 709 gift tax return. Now, you probably won't owe a dime in tax unless your lifetime gifts top nearly $14 million, but that doesn't matter. The reporting part isn't optional, it is mandatory.
And here is the absolute kicker. The normal 3-year countdown for the IRS to audit you, the statute of limitations, it only starts ticking after you file a return. By not filing Form 709 for this gift, you never start the clock. Ever. This means the IRS can audit this transaction forever. They can come knocking 10, 20, even 30 years from now, often right after you've passed away, and they're looking at your estate.
So let's just see how these risks pile up. You've got the $1 price? Check. That screams gift. You've got no 1099-S, which feels safe but is just a smokescreen. You've got no Form 709 filed? Check. That's the forever open audit window. And the final nail in the coffin? If you check the gift box on any of the county transfer forms, well, you've just handed the IRS a signed confession.
Okay, let's pivot for a minute. Because as scary as an open-ended audit sounds, it might not even be the most expensive mistake here. The bigger, more financially devastating trap is the one you've just set for your child. I call it the capital gains time bomb. To get this, we have to talk about something called cost basis. It's basically the number you start with to calculate your profit for tax purposes. And this whole thing is governed by two completely different parts of the tax code. When you gift a property, Internal Revenue Code Section 1015 kicks in, creating a carryover basis. That means your kid gets stuck with your original low purchase price as their basis. But when property is inherited, Section 1014 applies. That gives them a step up in basis, which resets the value to whatever the house was worth when you died, effectively erasing decades of taxable gains.
Let's put some real numbers on this to see the damage. So let's say a parent bought their house ages ago for $100,000. They do the $1 sale to their son because it's a gift. That $100,000 basis carries over to the son. Years later, he sells it for $1.2 million. So what's his taxable gain? It's the $1.2 million sale price minus that ancient $100,000 basis. That's a taxable gain of $1.1 million.
And the tax on that gain? Well, once you add up federal capital gains tax, net investment income tax, and state tax, you're looking at a tax bill of over $370,000. That is the true cost of that supposedly free house.
Now let's hit rewind. What if they did nothing and just let the son inherit the house? Let's say it's worth $1 million when the parent passes away. Thanks to that beautiful step-up in basis rule, the son's basis instantly becomes $1 million. So when he later sells it for $1.2 million, his taxable gain is only $200,000.
And the tax bill on that much smaller gain? Less than $70,000. Let that sink in. By choosing the $1 gift route, instead of just letting inheritance do its job, this family voluntarily paid the government over $300,000 in completely avoidable taxes. That is the real price of this clever strategy.
And if you think it couldn't get any worse, well, you'd be wrong. Beyond the federal gift tax and capital gains issues, there are a whole bunch of other landmines waiting for you at the estate and state level. Check this one out. It's from Internal Revenue Code Section 2036, the Retained Interest Rule. It says if you give away your house, but then you just keep living there for free, like nothing changed, well, the IRS says you never really gave it up. And they have the power to pull the entire value of that house right back into your taxable estate, completely defeating the whole purpose of the gift in the first place. And don't forget the states. This simple transfer can trigger a full property tax reassessment, meaning your kid could face a massive property tax hike. You could also make a simple mistake on the transfer tax forms and get a surprise bill. And this is a big one. It can totally sabotage future Medicaid planning, as it looks like you improperly transferred an asset for less than it was worth, leading to penalties.
Okay, that was a whole lot of bad news. So if you've already done this, are you just out of luck? Not necessarily. Let's walk through the critical steps you can take to mitigate the damage, and then talk about the right way to do this from the get-go. All right, here's your 4-step damage control plan. 1. File that overdue Form 709 gift tax return immediately. You have to get that audit clock ticking. 2. Make a formal record that your child's cost basis is your low original basis. This prevents an even bigger tax mistake later. 3. If you are still living in that house, you need to sign a formal lease and pay fair market rent. And I mean it. And 4. Go back and check all the state and local paperwork to make sure you didn't accidentally trigger a huge property tax reassessment.
Look, the bottom line is this. The goal, avoiding probate, is a smart one. The $1 sale is just a terrible tool for the job. The right tool, in most cases, is a properly structured revocable living trust. It accomplishes the exact same goal of avoiding probate, but it does so without triggering any of these awful tax side effects. Most importantly, it preserves that precious step-up in basis for your kids.
So I'll just leave you with this final question to think about. You went through all this effort to maybe save, $50,000 in probate fees, but in doing so, did you accidentally create a $300,000 tax liability for your child down the road? It's a perfect example of why, when it comes to taxes, you have to look past the clever labels and focus on the real-world financial substance.